Imagine a young couple in Lucknow, both school teachers, finally moving into their own home. This is the dream India Shelter Finance Corporation is helping fulfill across Tier 2 and Tier 3 cities. But what makes this company tick? Let's break down its business and understand its journey in the booming Indian housing finance sector. This essay aims to simplify India Shelter Finance for anyone keen on learning about finance and investments. We'll cover its business model, analyze its financial performance, and understand the opportunities and risks it faces. Think of this as a deep dive into the company's financials, but don't mistake it for investment advice. Our goal is to empower you with knowledge so you can make informed decisions. Founded in 2010, India Shelter Finance Corporation focuses on providing home loans to people in smaller towns and cities. This segment often struggles to get loans from traditional banks due to lack of credit history or formal income proof. India Shelter operates through a network of branches and uses technology to reach customers in remote areas. They primarily offer home loans but also provide loans for home improvement and construction. The company has witnessed significant growth in recent years, expanding its loan book and customer base. It now holds a respectable market share in the affordable housing finance segment, with a presence in over 15 states across India. To understand a company's health, look at its financial performance. India Shelter's revenue, which is the money it earns from interest on loans, has grown steadily over the past few years. This indicates its growing customer base and loan book. Profit, the money left after deducting expenses, is also on an upward trajectory, showcasing operational efficiency. However, it's crucial to analyze margins and asset quality alongside revenue and profit. Comparing a company's performance with its peers is essential. Two common metrics are the price-to-earnings or PE and price-to-book or PB ratios. The PE ratio tells us how much investors are willing to pay for each rupee of the company's earnings. A high PE can indicate high growth expectations. The PB ratio compares the company's market value to its book value, which is assets minus liabilities. A higher PB ratio suggests investors are optimistic about the company's future earnings potential. Analyzing India Shelter's PE and PB ratios against competitors in the housing finance sector can provide insights into its market positioning and investor sentiment. You know, India is currently facing a massive housing shortage, especially when it comes to affordable housing. But here's the thing. This challenge actually presents a significant opportunity for companies like India Shelter. With government schemes such as the Pradhan Mantri Awas Yojana or PMA, there are clear incentives for affordable housing construction. Plus, these schemes also provide subsidies to homebuyers, which is a huge boost. As a result, there's been an increase in demand for affordable housing loans, which has been a major benefit for companies like India Shelter. On top of that, rising urbanization and growing disposable incomes, particularly in Tier 2 and Tier 3 cities, are expected to drive even more demand for affordable housing. Honestly, this creates a really favorable environment for India Shelter's growth. While opportunities abound, India Shelter also faces challenges. A key risk is rising delinquencies. Delinquency occurs when borrowers fail to repay their loans on time. Borrowers in the affordable housing segment, often from lower income groups, can be more vulnerable to economic shocks, leading to higher delinquencies. India Shelter needs robust risk management systems to mitigate this risk. Additionally, competition in the affordable housing finance sector is intensifying, with banks and housing finance companies vying for market share. This could squeeze margins and impact profitability if India Shelter cannot maintain its competitive edge. Two crucial metrics for evaluating financial institutions like India Shelter are net interest margin, or NIM, and capital adequacy ratio, or CAR. NIM is the difference between the interest earned on loans and the interest paid on deposits, expressed as a percentage of average earning assets. It essentially shows how effectively a company manages its interest income and expenses. CAR measures a bank's capital concerning its risk-weighted assets. It indicates the institution's ability to absorb potential losses and withstand financial shocks. A higher CAR generally indicates a safer and more resilient financial institution. The Indian government has implemented several schemes to boost affordable housing and support housing finance companies. Schemes like the Pradhan Mantri Awas Yojana, or PMA, provide interest subsidies to borrowers, making home loans more affordable and encouraging homeownership. Additionally, initiatives like the Credit Linked Subsidy Scheme, or CLSS, provide further financial assistance to eligible borrowers. These government policies create a supportive ecosystem for companies like India Shelter, driving demand and facilitating growth in the affordable housing finance sector. India Shelter Finance Corporation is well positioned to capitalize on the growth in India's affordable housing finance market. The company's focus on underserved populations, coupled with favorable government policies, presents a significant opportunity. However, it is crucial to keep an eye on its asset quality, manage rising delinquencies, and navigate the increasingly competitive landscape. Investors and enthusiasts should closely observe how India Shelter manages these challenges and utilizes its strengths to maintain its growth trajectory. Remember, this essay is for informational purposes only and does not constitute investment advice. Always conduct your thorough research and consult with a financial advisor before making any investment decisions.